So it's really only 300 odd billion, and most of that's at the very large banks. So I think that graph is kind of taken out of proportion because JP Morgan's not going to have to sell their HTM.
I want to go to first, I want to make a statement, and then Michael, I appreciate you giving us the time and coming up. It's been a while. The statement that I have is that the Silicon Valley Bank just essentially remind us of how sensitive every bank is because of the reserve system, the fractional reserve system that we have, and like with the speed in which fear can spread, we saw that like Twitter led to the fear that we saw with Silicon Valley Bank. What, despite fundamentals being good in many of the banks, what prevents similar FUD or fear, uncertainty, and doubt to cause a similar run on those banks? Would love your thoughts on this, Michael, and would love your thoughts on the entire situation. It's a pleasure to have you.
Thank you very much. So look, one, I've written my thoughts down on my Substack. You can find that by going through my profile. And that's been pretty broadly shared at this point. So my guess is most people on this call have had a chance to look at something along those lines. The really key thing that I would highlight is the point that is being raised on the speed of what transpired, right? So there's several components of speed here. One is the dynamics of how quickly the deposits were withdrawn. That's a byproduct of a unique characteristic where this bank was largely a corporate bank and an ultra high net worth individual bank. And so instead of seeing accounts being withdrawn for $100,000 or $500,000 even, that you might see at your typical, Wells Fargo, et cetera, this was extremely large sums being taken out by corporate entities, all operating within a very defined universe that circles around people I've worked with in the past in Silicon Valley. And so there is no bank that survives that, right? I mean, I've heard other people say this, but it's just really straightforward. You take out a quarter of the deposits on any bank, they do not have the liquidity to do that. The programs that have been put in place by the Fed address that dynamic effectively, creating the ability to borrow against high quality liquid assets. But as other people, myself included, have pointed out, like that is a very small subset of banks, particularly smaller regional banks, where the majority of the assets that are being held are high quality liquid assets. That's actually one of the great ironies here is that Silicon Valley Bank did not engage in terrible underwriting, did not have, well, let me rephrase that. In this situation, as it relates to the losses that they've taken so far, it was not a function of bad underwriting. The irony is there were many people that were short because they thought that this bank had terrible underwriting policies. And I think that's going to be one of the interesting things that comes out of this is as there are greater restrictions around future lending, we'll probably find out that much of the lending that they did for airplanes and boats and various other stuff ends up being lower quality than we had thought. But that's not what drove this bank into bankruptcy. What drove it into bankruptcy was the fact that they needed to meet withdrawals of deposits. That's it. Like that really is it. And they just did not have the liquidity to do it as they had set aside a ton of money into what's called the hold to maturity portfolio. The minute you try to take losses or try to take cash out of those accounts, you have to recognize the losses. That meant that they would deplete their regulatory capital. Facing that, they tried to go raise money. Their depositors got wind of this situation and said, why bother? Right? Whether it was tied to a personal vendetta, as some people have alleged, I have no knowledge of that. Whether it was a prudent decision is something that we probably will not know for a very, very long time. Right? That has probably been ring-fenced at this point by the actions that the Fed has taken. But it hasn't changed, and this is really the key thing that I think markets are going to have to deal with and reconcile, is that the reason that deposits are leaving the banking system in general is because of the increase in interest rates that's been done by the Federal Reserve that has suddenly created a very meaningful challenge to the there is no alternative, argument. If we go back over the last 5 years, nobody was able to earn anything in their banking accounts or their savings accounts. Now suddenly they can put their money in a money market fund and get close to 5%. that's causing assets to leave the banking system in a manner that is almost destined to cause problems. And there is no solution for that. Like, people were not leaving the banking system over the past year because they saw, incredible risk to their checking accounts. They're leaving because they want to make more money. And the banks have artificially inflated their profitability by not raising their deposit rates. They don't have much of a choice because the portfolio of assets that they have accumulated over the last several years, right? Remember when you put money into a bank in your checking account or your savings account, they turn around, that's a liability for them. That's a way for them to raise money. They turn around, they buy other assets. Those assets haven't offered particularly high yields. That places a limit on how much they can actually earn on those assets. And in turn, the Federal Reserve has raised rates so fast that they have no real prospect of remaining profitable if they try to match the money market fund rates. So I think that's really what's going on is that this is really at this sits at the responsibility of the Federal Reserve.
Well, very astute, Michael. I agree with the macro part. There may just one thing I wanted to explore with you further is on the micro side. In their loan portfolio at SVB of 75 billion, 50 billion to funds, it seems, and maybe this is like a good retrospective on the quarterly call reports, but it seems like they were getting draws.
I lost you. Sorry, can you repeat that? I lost you.
Sure. Just on the micro level, in the SVB loan portfolio of 75 billion, there some credit stress events going on in there that need to be looked at, and they were hitting their lines and drawing fully, and also tapping their deposits for liquidity. And I think there could be some studies on how stressed their credit book was.
See, but that's not actually their credit book. So first of all, I agree with you. There is a unique characteristic with Silicon Valley Bank where their clients effectively were like unemployed people. They didn't really have jobs, right? They were money-losing corporations that continually need to draw down their deposits. What Silicon Valley Bank did not do a good job of, and I'd argue that the vast majority of people didn't do a good job of it, is anticipating that the IPO boom that really kicked off in 20 and 21 would stop and the flow of capital into their bank would stop. Right? We went through effectively the longest period in history without an IPO following, the nonsense that kind of ended in February of 2021. So that's not actually credit. It's not that they extended credit and then people could not repay the credit. It's just that people were drawing down their savings, or more accurately, corporations, unprofitable corporations with which they had banking relationships were drawing down their savings without access to significant additional cash. Right now, I actually agree with you. I think that we will find that much of the debt that Silicon Valley Bank underwrote ends up being poorly underwritten for a variety of reasons. I think there's a lot of questions around the dynamics of venture debt. I think there's a lot of questions around the idea of using non-public securities as collateral in a variety of ways. And I think that's going to be terrible, right? We'll find that out. And one of the key things that is ultimately going to play through is with Silicon Valley Bank now gone, that credit is going to be harder to find. And people who had relied on that credit will have more problems.
We'll see what the asset bids are for the loan book when the FDIC sells it off, right?
It looks like Oaktree is willing to buy this stuff at 40 to 60 cents. It's not a big vote of confidence.
Yeah, I totally agree. Right, that's what I'm saying. I mean, I think ultimately we'll find out that the bailout was bigger than we had anticipated because the quality of the loans is lower than people had thought, but that's not actually where the problem was. Not in terms of this immediate solvency.
Right. The liquidity
would have questioned the value of the loans in
so
this
just
way.
Quickly, a break just before I give you the mic. Jay Powell says the Silicon Valley Bank failure demands, quote, thorough, transparent, and swift review. Just thought I'd mention that. Also, the FDIC is still looking to sell Silicon Valley Bank. As expected, really. So just wanted to announce those things. Jake,
thorough and swift review of everybody except for him.
Jay?
Oh, sorry. No, I was just going to say there are a lot of banks that actually, have loans that probably need to be marked down, but because they're black boxes, because these financial institutions don't provide you information around the individual line items on their balance sheet. If Silicon Valley, instead of investing in securities in a very perverse way, had invested that $90 billion into floating rate debt, even if it was poorly underwritten, I don't actually think this run would have happened in the same way.
Michael,
It's actually the fact that they were transparent and bought, something that's one of the most liquid asset classes in the bond market, that we're actually able to estimate, how much the values could have been down after the December marks, that made it so obvious that in a bank run they would have negative capital.
Well, they would have had they would have had a capital requirement for floating rate debt. They had zero capital requirement for treasuries and agency MBS.
That's true too, but they wouldn't have had that hole that people would have been able to take advantage of. All they had to do was to buy an interest rate hedge.
Yeah, I think that's true. Although I think that there's, again, I wrote about this. I think there's some dynamics in terms of that hedge that feel very obvious in hindsight. That is less clear at the time, and part of the reason why they did not hedge was precisely because they wanted to make a little extra spread on it. So that speculation, they obviously got that call wrong.
But that goes to the culture of the bank, right? It's like growth at any cost. It was essentially a Ponzi bank where these VCs burn 10 to 30% of their cash every month. On the flip side, they have to raise more and more money from new capital raises so that their deposits grow. And then last year, when their deposits slowed down, management freaked out, and they knew they would have to sell these securities probably in the fourth quarter.
I actually agree with Jay that we will find out in hindsight. And again, I think Oaktree's bid at 40 to 60 cents is telling you this already. And again, that's a preliminary bid, right? They're not bound by that. And if they win the right to look at that loan book, they're probably going to try to negotiate that down as low as they possibly can. Oaktree's not doing this. They're probably bidding high
out of the goodness of their hearts.
Yeah, exactly. They're not doing it out of national interest. But that's part of the great irony is that most people knew that Silicon Valley Bank had huge Ponzi characteristics to it. We know that you're not supposed to with venture debt in the way that the venture debt doesn't really even exist. It's just kind of a stupid way of saying, okay, here's a way that we're not going to dilute the equity of our very important clients.
So Michael, are you being asked to look at peers that might be in a similar situation?
So everybody is searching for peers. That's not my job, right? So that's not what I do in the same way, because I'm not a stock picker anymore. I've unfortunately had to move beyond that. But everybody is searching for the next Silicon Valley Bank, right? And there are unique characteristics here. I think Jay laid it out very well that they made a mistake with a high quality liquid asset portfolio that doesn't require transparency for us to know what's going on. Now, I'll tell you the great irony of all of this is that we've all forgotten about the Blackstones and others already because we're so focused on Silicon Valley Bank right now. But man, you want to talk about transparency and things that are mismarked. We know they're mismarked, and we know it's going to get much worse. Right?
It's going to get much worse. I mean,
what happens to commercial real estate when you destroy all the new entrepreneurial ventures that are randomly accumulating real estate?
And over $1 trillion of you look at the delinquencies in the auto sector, you look at CACC and Ally and what's going on with the lower end consumer. You're going to have banks, regional banks that lend on used cars with higher LTVs on top of commercial real estate, all coming to a head in the second half of this year, next year.
And that's one of the really critical things that I would just argue about this, what I think is a ridiculous Fed, quote unquote bailout policy. The fraction of banks that have the vast majority of their assets in high quality liquid assets that would be able to take advantage of the dynamics that they're talking about is low. It's just really low, right? The majority of them will have things like CRE loans or, Jay brought up some examples around auto loans, et cetera. Like these are all much bigger areas than kind of the super high quality liquid assets that you go into when you don't have time to underwrite a portfolio.
Michael, I've got a quick question. Something you mentioned early on. Actually, before asking that question, Nomura's prediction about a 25 basis point rate cut and an end to quantitative tightening. Pretty extreme take. Others like Goldman Sachs echoed that. That's being that the market's pretty much
for a pause, right? Goldman called for a pause, and that I think is probably reasonable. I don't put it past Jay Powell to hike by 25. I think 50 is definitely gone. I heard Jay earlier alluding to it may raise more concern. It may make people say, "Oh my God, what's really going on?" if they don't hike by at least 25.
Or pause. Yeah.
Or pause. I mean, my bet is on pause, right?
Yeah. If they cut, do you think that people would just freak out, right?
Yes. Not just because, just to be very clear, not just because of the signal that it would send, but also because one, that first cut does absolutely nothing. Cutting by 25 basis points or 50 basis points does absolutely nothing.
Michael,
it just causes chaos in market position.
We were talking over the weekend, and I was on the spaces. I don't know if you were listening, but that was my prediction that you see two banks collapse within a week, and then the Fed announcing the first of their sort of emergency, this BTFP loan fund that they're going to do, where the banks are now able to post these securities at par and take out loans with the bank. So it's just hard to imagine, given that in a week from now that the Fed's going to hike rates. So my prediction was just a pause. But yeah, a cut of like 25 bips will do nothing, and it will actually invoke more people will panic. But just maybe you can comment on the bond market itself today, because that's another thing I was talking about, was how the market will react. And I'm surprised that equities held up, but again, the dollar was down big. But the bond market, huge rally and massive drop again in rates. And the 2-year right now is just under 4%. So maybe you can talk about what is the market. I mean, I think the market's telling us that to expect a pause, but maybe you can comment on that.
Well, I mean, a lot of people are also aware, probably the happiest person out there right now is my friend Alex Gurovich, who is one of many people that points out that the Fed almost never pauses, right? Once they're done, and the economy is going to deteriorate enough that they'll be forced into cuts eventually. But that cutting 50 basis points is like, yeah, it'll show a little markup in terms of, the 2-year will mark up, and we've got a fund that we built around those dynamics. But the vast majority of portfolios are not going to benefit they may benefit from some securities appreciation, but the way that stimulus really works in terms of cutting interest rates is that it allows corporations or households to refinance their debts at lower interest rates, right? So that puts additional cash in the pocket of households or corporations. And the problem is that we're so far away from those levels right now that it's just not even a realistic prospect until like the Fed basically panics, like truly panics. And that, I mean, I'm sure Jay has a perspective on this as well, but like, this is the point I keep banking on this, which is there haven't been many mortgages written at 6+%, right? That's part of the collapse that we've seen in the housing market in terms of transactions and everything else, is people are just saying, unless I absolutely have to, I'm not going to do this transaction now. That means that there's just not many mortgages eligible for refinancing.
Hey, I wanted
to. So you can't
go
put
ahead.
money back in people's pockets.
I wanted to put something to you too. So I follow Jeffrey Snyder. I mentioned him before, and he was just posting how global markets. Here's a tweet just a few minutes ago. He says global markets are not buying that everything is fine. On the contrary, they are buying hedges in a way I've never seen. He goes on to note, explaining it to someone. It means that the biggest money lenders on the planet, from all over the planet, just rushed to take out end of world insurance, see USCDS, all at once at the same time. No one wanted to sell any of them.
Yeah, I think that's right. I mean, if you look at what's happened to implied volatility, the move index, et cetera, like there's just been an explosive move in volatility on particularly interest rates. Part of that, there's a good Bloomberg article talking about the dynamics of quants being caught off sides. You know, we have a strategy that absolutely that happened. You know, where it's a quantitative strategy, it rebalances on a daily basis. So if you think about the mechanics of what transpired, when you have the type of move that occurs on Friday, that signal comes in, leading to transactions expected to happen today to rebalance that portfolio. Today's move, of course, everybody's getting similar signals, causing an even larger impact on the market. And by the time you go to rebalance the portfolio, like you're getting killed, right? Just absolutely slammed. That's part of what happened in March of 2020, ironically, is that the Fed was so aggressive in its rate cuts that people with derivative exposures outstanding just got blown up, right? And that you could do that right now if the Fed were to cut aggressively.
And it seems like the trajectory of everything we're witnessing very much mirrors the trajectory of some of the inflation, the trajectory of some of the challenges we had over COVID, which was everything's backed up, right? The boats are off the shore of Los Angeles. They can't get anything to the docks. Prices are going up. The cost of getting something over on a boat from China skyrockets. Then everything unclogs. And the Fed is acting too late. The whiplash scene of eggs going up, eggs going down, bananas going up, bananas going down, gas going up, gas going. It's just that slingshot terribleness. You can't predict anything. And now we're seeing that, play out in real terms on, market financials and bank fundamentals. Is part of this just the absolute whiplash? I think you mentioned your true inflation, and you're wondering, like, how are they so off, right? On certain points, it's like, it seems like everyone's off because you can't predict anything. It's such a whiplash.
It's not so much as you can't predict it. It's that there's 3 or 4 components that play into that, right? So one is part of what you're referring to are the studies of what's called system dynamics, right? So systems that have multiple pieces in them are much more complex to model than very simple systems, right? And so as economists, we talk about supply and demand. Well, supply and demand of what, right? When we talk about eggs, are we referring to supply and demand of the chickens? Or are we talking about the actual eggs themselves? Are we talking about the drivers to bring the eggs to the store? Are we talking about the trucks required to transport? Are we talking about the cardboard boxes that are required to transport them, et cetera, right? There's a very famous...
And when we're talking about this whole egg situation, like people are conflating it with inflation, but we had the biggest bird flu epidemic in years. So like people are, looking at egg prices, whereas lumber prices are at like the December lows, multi-year lows. And, people are focusing on, this one category because the media is talking about it.
Correct. And that's like, there's a very famous essay called "No One Knows How to Make a Pencil." And it's true. Like, how do you make a pencil, right? Nobody really knows how to make all the individual pieces of it. The economy is the same way, right? And so when you shut down a very complex system and then you try to restart it, it's no different than an old person waking up in the morning. They've got arthritis. They've got to stretch. They've got to move around. They've got to do things, right? Well, if you try to go from getting straight out of bed to running a marathon, it's just not going to work. And that's by and large what we did.
Yeah, and when we get to the, when the rubber hits the road, when you go and talk to some of these egg farmers, you talk to someone on the ground, they have very different reasoning as to what's happening. I remember for the interview for the books I did on COVID, I talked to longshoremen, I talked to people there at the gates, right there on the shore in LA, and they were talking about how they didn't have enough staff. And the reason they didn't have enough staff is that California law prohibited them from training their trainees in the same cabin because it was feared they would spread COVID. So all the trainees did their training on virtual machines, started failing, and they didn't have enough staff to really get all the things. It was like a major factor that no one really uncovered, right? And so, like you said, there's so much complexity to this whole endeavor, and people just want, are things flowing in the right direction? And I sense that they're not, and everyone senses that, and today is not terribly reassuring.
Michael, I'm going to ask you a simple.
I unfortunately would like. Sorry, let me just address that question before I move on to the next one, which is, I think the fortunate thing is actually they are flowing in the right direction. It's just we're all really impatient, right? And it doesn't feel like that, but Jay's highlighting. Guess what? Lumber prices are near all-time lows. The egg shortage will resolve itself. The port of Long Beach has unclogged. Nobody is, desperately looking for a computer anymore or a GPU.
Container rates are down 90%.
Oh, absolutely. That's the slingshot, though. Yeah. If you thought that your big shot TV was cheap at Costco 2 months ago, it's extraordinary what you can buy these large TVs for, because they're just going for pennies on the dollar. People trying to get rid of inventory that they hoarded up.
So if you have FIFO inventory, to what you're saying, FIFO inventory is first in, first out. If you are a company that, for example, is buying grills for Home Depot and Lowe's, and you were a pandemic beneficiary and there are supply chain issues and you couldn't get all these parts you needed, for people to grill in their backyards, there are huge supply chains that are now full of this inventory, and Lowe's and Home Depot are marking it down very dramatically. And not only are they marking it down, for a 20 by 20 container from Guangdong to the port of LA cost $12,000 in March of 2021. Today, it costs about $1,900. We can all do the math.
Yes.
If there's 40 grills,
isn't that a demand issue? I mean, there's just no demand, and so the prices drop like a rock.
Yep, it's a demand issue. It's also a supply issue of new container ships coming on the market. There are 40 grills on average that can fit onto a 20 by 20 container. Now, that's $135 a grill. The average Weber grill or Traeger grill costs about $650. So I'm telling you that 25% of that cost of a grill was just transportation costs. And with FIFO inventory, if your inventory days are 200, which for big ticket items, that's a few months, that means over the next 3 or 4 quarters, prices for these TVs and grills and big ticket items, could come down 10, 15% as they pass some of that margin on to the consumer.
Well, I have a question then, maybe you guys can discuss better than I can how the Fed's using these inflation gauges like CPI that have so much lagging data. And especially when they talk about unemployment, which is sort of also a lagging indicator as well in their rate policy.
Well, the New York Fed survey of rates a year from now would show inflation. I think they're saying 4.2%. January last report CPI was like 6.4% annual run rate. So, I mean, it seems like there's a sense that you're going to have, improvement on inflation a year from now. And so maybe the bank asset managers are like, okay, I can hold on. Maybe I can keep my forgetting hedging. If they're just naked in long-term debt or treasuries or MBS, they're going to probably get some appreciation in that portfolio between now and a year from now. But if you have these liquidity events like SVB, all bets are off. You have to worry about dealing with liquidity.
Got us some DMs here. Maybe you guys can answer these questions. The U.S. cannot issue new treasuries when we hit the debt limit, correct? Will any of this cause us to hit the debt limit faster?
That's driven by fiscal, and we're probably 5-6 months off from that anyway. But it depends on what Congress does. If they keep just spending like drunken sailors, then we'll hit it faster.
Michael, I want to go back to a comment you mentioned earlier. It's just a very simple question. So what led to the fall of Silicon Valley Bank is not all the issues we've been discussing. It's just a run on the bank. It's just fear created by a bunch of VCs. So if this is the issue that led to
it was a combination of a very transparent portfolio of assets that people knew they were effectively wiped out. When the rumors of that hit, it torpedoed their ability to raise capital and subsequently led a very tight-knit community to withdraw large sums of money in a short period of time. Right. This really was It's a Wonderful Life. Right. Like that is what happened here.
And what would you expect over the next few weeks with the rest of the regional banks? You know, I've had a few people message me, people that were on the panel over the last 3 days, with pretty concerning messages. I read a few of them out earlier. What would you expect to see over the next week or two, or even month or two?
So I think part of it depends obviously on how people react. I tend to fall into the camp, sounds like Jay is there as well, that this is the opening salvo in a much deeper story about what happens when you dramatically tighten financial conditions without the proper metrics for measuring financial conditions. So I've put out many tweets on this. I've actually written about this, et cetera. All of the metrics that we have for financial conditions measures work off of spreads, right? So what is the spread between mortgages and treasuries? What is the spread between high yield and fixed income rate and risk-free rates, et cetera? That's a useful metric in an environment of stable and falling rates, but it gives no consideration to the absolute level of rates, which can also create their own problem. And so, effectively, we're driving a car, that car does not have a temperature gauge, and we're like, oh, it should be totally fine because we're going the speed limit, right? Meanwhile, the car is in the process of overheating. We just don't have the tools in place that are properly allowing us to monitor this. And because Jay Powell decided to do something that nobody has ever done before, which is go from 0% interest rates to quite restrictive interest rates. Don't get me started on the nonsense around real rates and inflation and all that sort of stuff, because candidly, nobody experiences the same inflation. That number is an aggregate nonsense metric. It goes right back to the same thing I was saying about how do you make a pencil, or are we talking about a shortage of eggs or chickens or boxes or drivers, et cetera, right? There is no single inflation experience that anyone has. These are estimates that are designed to help us guide things, but there's a common sense component too that, I'll be honest with you, I think our appointed officials as compared to our elected officials who have no common sense whatsoever, our appointed officials do not have adequate common sense. And so, we've created conditions that are highly, highly restrictive at the same time that we're telling ourselves that they're not.
In any other economic cycle, you would have seen, what's 100 billion of treasuries rolling off the Fed's balance sheet, outside of the MBS, and interest rates at 5%, up 400 basis points, being extremely tight. So for anyone who thinks, like, I keep hearing people say, oh, they need to tighten to 7%. They need to tighten to 8%. We're going to Volcker. We're going to the 70s. Like, do you have any idea how much debt we have now versus the GDP versus then? Like, you can't compare it. We were a manufacturing economy with a growing population. Today, we're a service economy with, 10 times the debt to GDP. I don't think people are even vastly, even touching the iceberg of how irrelevant some of those concepts are. Like, this is the Volcker era, et cetera, et cetera. The Fed cannot afford to raise rates much more than they've already things are breaking.
So if the Fed does pause their hawkishness or even reverse its course, is the problem fixed? Is it back to business as usual?
It's not fully fixed because of commercial real estate.
Jay, your mic is not great. I don't know why.
Oh, sorry. It's not perfect because of commercial real estate. But I mean, look at what happens when the 10-year falls. These mortgage bonds are probably up a ton in the last 2 days.
Michael?
Yeah, I actually agree with Jay that, allowing the 10-year bond to rally, and the idea that they are going to pause the cycle and that the terminal rate is going to be lower is helpful for collateral. And it is somewhat helpful for the wealth effect. I think that's going to be subsumed by the dynamics of the degree to which we have already hiked and the deteriorating credit quality that we're experiencing in the economy.
Mr. Strain, Michael Strain?
Yeah, sorry. I wanted to comment on the hiking cycle. I agree that that this is an example of something breaking as a consequence of the tightening cycle. But my sense is that